Disclaimer. This podcast is for FCA authorized financial advisors only and is not for retail clients. The views expressed in this content and all other content on this channel are those of the individual speaking and do not constitute financial advice or a recommendation to invest in any product, asset, or strategy, including those discussed in sponsored segments. This content is for educational purposes only. Always do your own research and consider all relevant risks before making any investment decisions.
Joined the industry after a stint in the army in '98. The army is, from a personal level, taught me a lot. What they're teaching you, they use the vehicle of a platoon attack to teach you everything. Financial services are hard because it's like herding cats. Everyone's got an opinion in finance, which is really, really unhelpful. Before I say I put 100 grand into Bitcoin and I now live on an island next to there's a bond villa. I sadly I didn't buy any Bitcoin at all in 2012. I think you can cut and paste it. Surely it's on the internet. You just cut, then you've got 2 Bitcoin. And then about a year later, I clicked and went, oh my god, this blockchain thing is pretty impressive. Watching it grow up and get beaten up every single cycle and then come back stronger. Every single time they've tried to beat this thing up, it's come back. There's no CEO, there's no board, there's no replace the department. This is a technology that's out there. This is a neutral asset. It's global. I also have this idea that Bitcoin and gold live together. Bitcoin's as you say, the store of value of the internet, the reserve of the internet, and gold's the reserve of the physical wealth. So we launched in April 2022, and in US dollar terms, gold is up 119%.
Nothing stops this train. They are going to print money. We are going to have an inflationary environment. Hi, Charlie. Welcome to the Bitcoin IFA Podcast.
Hi, Dan. Good to be here.
Charlie, you've got a really interesting financial services journey. Talk us through that.
I joined the industry after a stint in the army in '98. I joined James Capel, which was owned by HSBC, and it was rebranded HSBC Global Asset Management over about 2 or 3 brands that we went through, but it was always that. And it was a private client business. And in 2002, I was picked up to join this absolute return team. And I ended up heading that by 2004. We basically built portfolios that, we had that awful .com bear market, and the clients were looking for more security in their portfolios. And it was a fantastic time to be an active investor because the US was outperforming, the dollar was falling. And if you picked up on things like commodities and emerging markets, then you were away. And so we had really, really strong period running up until 2007-8. And I ran that business, grew it to $3 billion. We had diversified portfolios across bonds, equities, and alternatives such as commodities, hedge funds, private equity, real estate, that kind of thing. So, we were early adopters on the whole diversified multi-asset portfolios. And I stayed with HSBC till 2015 before I set up my own firm, ByteTree, and here I am today.
Yeah, we're going to touch on ByteTree. Would you say that the stint in the army influenced the way that you gave advice or the way that you've worked in financial services since?
Well, the army is, from a personal level, taught me a lot. I mean, Sandhurst is the best free education you could ever get. Fantastic. And it was a really, really exciting year. You were never bored, no time to be bored. And you're just learning. What they're teaching you, they use the vehicle of a platoon attack to teach you everything. Whether it's presentations or whether it's communications or it's leadership or and the idea that you're running up a hill trying to shoot 8 people with 30 is sort of irrelevant, really. You could have applied it to anything. You're trying to organise in a crisis environment 30 people to do the right thing at the right time, and that's the sort of the end game to the whole thing. But it's just you spend a lot of time in the classroom, you learn about military history. And you get fit. I've never as fit in my life as that day I left Sandhurst. Wish I could get back there. And it's just so much to it. And I'd recommend it to anyone. It's brilliant.
Yeah, it certainly sounds like the leadership under stress environments and getting everyone pulling together in the same direction. You're absolutely correct. It sounds like that's absolutely applicable to almost any environment, even financial services.
Financial services are hard. Because it's like herding cats. Everyone's got an opinion in finance, which is really, really unhelpful.
Completely agree. And you touched on something there that you touched on commodities and multi-asset funds and active managed funds. we've obviously seen a very large shift in the last sort of decade and a half, probably since the GFC, to predominantly indexed, passively managed index global equities and very little in terms of commodities and multi-asset funds. Why do you think there's been that shift?
Well, indexation is pretty old. I mean, it goes back to Jack Bogle, doesn't it, in the 50s or 60s, and it's just been growing and growing and growing. And even in the late 90s, there were lots of active so-called funds. There were plotted trackers. They really did look a lot like an index fund, and that's just become. People have sort of given up pretending that they were active managers, and they're now just formally going in and tracking the index. And the ETFs now are so big, 14 trillion or something, and the fees for the major indices like the S&P 500 are so low that it makes a lot of sense for an advisor and a regulator to encourage that kind of thing, because it's this view that there's a market return, and while the minority can beat it, the majority can't, and so therefore the focus is lower costs. So I kind of understand how we got here, but I think that you can win and you can do better than the market, and sometimes the market itself is very dangerous. You can build a much less risky portfolio of shares and things and other things, but by taking heed of the fact that 40% of concentration in the S&P 500 is in 10 stocks or something. So it's not difficult to go out and buy not just value, but different things that are going to behave to different scenarios, and so diversify your portfolio efficiently. And that's what I've been doing for a long time, and hopefully I'm quite good at it.
I had Rick Edelman on recently, and he said exactly the same. If you're looking for diversification, you diversify across everything, right? So it ends up being commodities and some real estate and things like that, and you also end up investing in things that you don't necessarily like, right? So one of the arguments against Bitcoin, I don't like it. Okay, but do you like fixed interest rate securities? Do you like every equity that's in your equity pot? There's going to be, pick the thing that you're against: weapons manufacture, alcohol, tobacco, whatever it is, pharmaceuticals. They're going to be within that index of funds. So I completely agree with you on the diversification point, and some actively managed funds can outperform. Absolutely. We are probably going to touch on ByteTree, but this is a Bitcoin podcast, so everyone's against Bitcoin until they're for it. What's your Bitcoin journey?
2012. So before I say I put 100 grand into Bitcoin, and I now live on an island next to there's a Bond villain. I sadly I didn't buy any Bitcoin at all in 2012 because I dismissed it, saying to the friend of mine who introduced me to it, I said you can cut and paste it. Surely it's on the internet. You just cut. Then you've got two Bitcoin.
Control C, Control V.
Yeah. And then about a year later, I clicked and went, oh my god, this blockchain thing is pretty impressive.
Hi team, a quick interlude to ask, what if you could offer your clients Bitcoin exposure on a regulated investment platform? Because that's what my friends at P1 have done. They've created a discretionary model portfolio invested into companies with significant operations in digital assets, available within general investment accounts, ISAs, and pensions, and managed by award-winning investment professionals. With P1's digital assets portfolio, you can access a professionally managed portfolio of listed companies powering the digital asset economy, such as miners, blockchain infrastructure, payment services, and listed companies with Bitcoin treasury strategies. It's Bitcoin and digital asset exposure built for regulated advisors. It's diversified, actively managed, and with full transparency. P1 created the portfolio for advisors who see the long-term potential of Bitcoin and the digital asset economy, and who are starting to look at how best to facilitate exposure for their clients. It is packaged in a way that fits into an advisor's day-to-day investment advice process. So if you're an advisor who wants to offer digital asset exposure without the operational headaches, visit the URL in the show notes or use the QR code on screen. P1, bridging traditional finance and digital assets. Only available on the P1 platform and via regulated financial advisors, and the value of investments can fall as well as rise and you may get back less than you originally invested. Now back to the show.
And that really, really struck me, because it occurred to me from there on, you could actually own property on the internet. And the internet had done wonderful things. It had grown, and e-commerce was kicking off by that point. I mean, don't forget, in the late 90s and stuff, it was more about eyeballs and concept than it was about profits. But those profits started to come through thick and fast after the credit crisis. And Bitcoin was launched around that same time. And as soon as I realized that you could actually have property on the internet, not just someone sending you an email saying that's your claim on XYZ, but something that had hard proof with a blockchain, then I just got very excited at the space. And it wasn't Bitcoin that, I mean, of course, Bitcoin was going up in 2013, so that was interesting. But then it went down a lot in 2014. And I just spent a lot of time studying it and trying to understand it. And ByteTree was really kicked off as a research project to get inside the blockchain, see what was going on. And, we basically uncovered the fact that there are lots and lots of copycats. There wasn't much to them, but Bitcoin was the real deal. All the data stacked up. You could see the transactions coming through. You could just about measure the amount of dollar value that was going across the internet. You could correlate that to the market cap of Bitcoin. And obviously, for the market cap, you can get to price. But the number of Bitcoins in those days, well, it still is, but changing every 10 minutes and growing every 10 minutes. But then it was much faster, with a reward of around 25 per 10 minutes. Now it's point whatever it is, 3. And just watching it grow up and get beaten up every single cycle and then come back stronger. And the banks tried to make it very difficult for people to invest in Bitcoin in 2014, 15. And then the stable coins came. And every single time they've tried to beat this thing up, it's come back. And you just got to realize there's no CEO, there's no board, there's no complaints department. This is a technology that's out there. A bit like gold's an element, and you can't change that, or the air we breathe. This is a neutral asset. It's global, and it's just I'm massively on side with not just Bitcoin, but the whole concept of blockchain. Which is not to say that I love Dogecoin and that sort of thing. I don't, but I take it that the whole crypto sphere is very real, and Bitcoin's at the front. The other thing I'd say, Dan, is that we've got this Bitcoin dominance. I mean, the thing I got completely wrong since 2013 was I assumed that Bitcoin would be 5% of the crypto index or whatever 10 years later, but it's been 60 and always 60. So there is something about that. You have to look at the market and say, we've been through these cycles, and every single time Bitcoin, comes back stronger, despite tens of thousands of new ideas and projects launched. It maintains this massive index dominance, and you can't ignore that.
Completely agree. And there's a few things you've touched on there. So you're absolutely correct in that Bitcoin is essentially the democratization of money, and it's the internet of money. So I show in my workshops how new technology always usurps the incumbents, right? So I show, Instagram usurping Kodak and Apple usurping Kodak, the digital cameras usurping Kodak. And Kodak, by the way, invented the digital camera in 1975. Didn't bring it to market because they couldn't keep the recurring revenue from film. So they said, no, we're not going to do this. I show Netflix versus Blockbuster. Blockbuster had the opportunity to buy Netflix for pennies on the dollar in the year 2000, but couldn't see the impact that the internet was going to have on streaming. There's things like, the classic democratization of music, right? So we stream everything now. You can stream the individual song you want. You don't have to buy a $20 album to listen to the one song that you're interested in. And Bitcoin is just the latest iteration of that. It is the internet of money, right? And it's how the internet is changing things. Absolutely correct. And then the dominant thing I really like, Bitcoin, it was super dominant, wasn't it? Until sort of 2014, 2015, I think it was like 95% of the total market cap. Then it plummeted. And you're absolutely right that it's, each cycle is sort of bouncing and ranging between sort of 70 to 40. depending on where we are in the cycle and people moving out on the risk curve, selling out of Bitcoin, moving into ETH and XRP and Doge and unicorn fart dust, but it always bounces back. You're absolutely correct. So then you mentioned that you launched ByteTree in sort of 2013. What was the gap in the market that you saw, and what were the problems that you were trying to solve?
Well, back then it wasn't really a very clear business plan. It was more of a research project. It was a very low budget company with a very minimal funding, and we had a guy, the guy who set up with me, Mark, who I just paid for him full time to be digging into the blockchain and producing real time statistics, and there was a sort of vague attempt to build a business, which was, you could call it the Bloomberg for Bitcoin. So people like yourself, Dan, and other financial professionals might want to log in and see what's going on. But there's, what's happened is so much free stuff just appeared that business model didn't work out. But we plodded on and did other things in the space. So we launched a Bitcoin hedge fund in 2020 with my former colleague Charlie Erith. He left us, and we wished him well. And then we also launched a Bitcoin and gold fund, which I'm sure you're going to come on to soon. And then the other thing we do is we launched a research business. So basically what I do today, what is ByteTree today? It's a research business with, research in digital assets, but also traditional finance, like I did in HSBC. I'm doing the same thing I did at HSBC, but now for myself at ByteTree with digital wealth management regulated by the FCA and so forth. And we have other products as well. So we've just sort of evolved and tried to take this opportunistically and try and do something useful.
Well, I think that's absolutely correct. If you add value, people will come to use you, right? And yeah, you've mentioned the BOLD ETP there. Let's jump onto that because I'm super interested by it. So that's a ByteTree and 21 Shares collaboration? Is that correct?
Yes.
Okay, great. And talk us through that. So again, what problems is it solving? What value is it trying to add?
So let's go back to gold. It's gold and Bitcoin ETF. Let's dig into why and how and when. I've been a gold guy. I hate the phrase gold bug because I try to be neutral about everything I do. I don't love assets or hate assets. I just sort of try and build portfolios and what stacks up. But I became very bullish on gold in 1999. Soon after I joined HSBC, I went to a presentation by Tocqueville, and there's this really old guy at the time when I was much younger, and now I'm the old guy. But he had obviously been slaving away in this 20-year bear market for gold from 1980p to 1999, and well, there's this gold thing and it's really cheap. It was $250, and of course it did. Gold is up 14 times or something since that presentation, and gold's always featured in my portfolios. Largely for much of the time, but I am objective. So in 2013, the year when gold collapsed because of the change in real interest rates and so forth, we didn't have hardly any gold in our portfolios. And I got a bullish on gold very much so in about 2018. And all this is written down and published and freely available in a thing I write called Atlas Pulse. But then I remember there's a time just thinking, conceptually a gold portfolio should have 5 to 8%. Sorry, a balanced portfolio should have 5 to 8% gold. That's written by the World Gold Council. They've stacked it up with research. And then basically, if you own gold instead of bonds, over very long periods of time, it's generally been a better bet. Not always, but much of the time, and you sort of get that sort of inflation protection, perhaps, but also the times of uncertainty and the stability and just straightforward diversification. When something else is doing, it's going up and something else is going down, that's always a win. And so if you buy into the idea that a portfolio should be something like 5-8% gold, then you sort of go, okay, if Bitcoin's real, then it's probably 2, isn't it? Something like that. Let's start with that, being very conservative before we get excited about it. And obviously in 2013-14, you couldn't own Bitcoin easily as an institutional investor. But then the funds started to come, firstly the Swedish ETF, Bitcoin shares, and then 21 Shares set up in 2019. To cut a long story short, I also have this idea that Bitcoin and gold live together. Bitcoin's as you say, the store of value of the internet, the reserve of the internet, and gold's the reserve of their physical wealth. And I think that's pretty obvious because if you look at their economic characteristics, they're quite similar. they're sort of limited supply and that sort of thing. And they're deemed to be something different. They're basically alternative assets. Alternative assets are not financial assets. Financial assets pay dividends, bonds, real estate, equities. Alternative assets, commodities, crypto, fine art, fine wine, don't. So, but that doesn't mean they're awful. I mean, you could certainly invest in alternative assets and do very well. And one of the problems with most alternative assets is they're not liquid. But Bitcoin and gold are massively liquid assets. Gold is nearly as liquid as the S&P 500, $150 billion a day, and Bitcoin catching up and getting better. And I said, okay, well, let's put these two assets together, because intuitively, it was pretty obvious that you could see when Bitcoin was doing well, gold was generally slumping, and vice versa. And so when Bitcoin was slumping, gold was probably doing well, or at least not doing badly. And so these are a natural pairing, just like bonds and equities in theory are a natural pairing, not so much these days, but that's what we've been brought up to believe. Bitcoin and gold are a natural pairing. And obviously gold is the slower one, it's the cautious one, and Bitcoin is the faster, racier one. And just by using a simple inverse volatility calculation, which is straight out of the financial textbook and commonly used in min-vol funds or min-variance funds, call them what you will, I use that strategy to say how much Bitcoin and gold to own. And right now it's about 32% Bitcoin, 68% gold. So if you think about it as a ship where the ballast is the gold in the bottom of the hull, and the spinnaker is flying high, and that's the Bitcoin. It's something like that, and they naturally balance. And so the result of this BOLD strategy, Bitcoin and gold BOLD, is that there are 14,000 ETFs in the world. We launched this one in April 2022 with 21 shares in Switzerland, and I'm pretty damn confident that of 14,000 ETFs, we've got the highest Sharpe ratio of them all.
For some advisors, right? So, and also myself, I'm not ashamed to admit, I think I know that you want your Sharpe ratio to be around 1 or over 1,
Yeah.
but I don't really understand what the Sharpe ratio is. And when I think back to my financial advice training, there was absolutely no training on Sharpe ratio. So why is that important? What are the Sharpe ratios, and why is it important that you guys have the highest?
Well, not everyone rates a Sharpe ratio, and often they don't rate it for the wrong reasons. So if they, look for the right reasons, they probably would rate it. So it's volatility is a measure of how something varies over time, and past volatility and future volatility are pretty indicative. So if something's been volatile, it's likely to continue to be volatile. Not always, but when your asset is very, very liquid, the more truthful that is. So real estate volatility is completely hopeless, or small caps or something. But when you've got big liquid assets, their volatility has been 50% for the last 5 years. It's probably going to continue to be something like that. Gold is something like 15 to 18. To put in perspective, the long-term average of the S&P is about 14, the FTSE about 15. These days they've gone lower, which is part of financialization, where volatility in markets is super low. The 10-year bond's probably about 7 on average historically. The 20-year bond's about the same as gold. And the 30-year bond is more volatile than gold. And Bitcoin is less volatile than Nvidia. It's less volatile than Tesla, about the same as Meta. These days, Bitcoin was a very, very volatile asset, but anyone who still calls it volatile is behind the curve, because its volatility is collapsing. It's now, my measure of 12-month volatility has it at about 38. And, that's mid-range for large cap stocks. It is not something that stands out as crazy at all. So the Sharpe ratio basically looks for the return per unit risk in this case being volatility. Now, the volatility of the BOLD ETP has actually been lower than gold because of the non-correlation. So you've got 40%, let's call it 38% volatility for Bitcoin, around 17 or 18 for gold, and actually being 1 point under that, because basically when gold goes up, Bitcoin goes down, and when the other goes down, it goes. And that keeps on happening, and that natural negative correlation means that you get diversification. So the S&P 500 or FTSE 100 has got lots of volatile stocks in it and lots of calm stocks. But when they work together, they reduce the net volatility overall. And that's the benefit, the free lunch of diversification. Now, what we're just saying here by that Sharpe ratio is that this is a very efficient product. Because if you did the same trick with gold and silver, you wouldn't have that result. You would have no excess return, and you'd have no reduced volatility beyond the obvious mix, the average of the mix. And the same with Bitcoin and Ethereum. But when you put Bitcoin and gold together, you do get something magic because they're naturally uncorrelated, and they're big and liquid, and they do different things at different times. So the result has been great returns without much volatility for a portfolio manager, asset allocator looking after other people's money. It's fabulous.
Absolutely. I mean, that sounds like the holy grail, right? So certainly when I was doing my financial advice training, volatility was almost a dirty word, right? So it was everything that the umbrella organization that I worked under, everything they did was about minimizing volatility, including the smoothed funds. So try and remove that volatility entirely, without recognizing that volatility works both ways, right? Volatility works to the upside as well. And in a portfolio, in a diversified portfolio with some volatile assets, when you get that volatility to the upside, you're able to rebalance into the less volatile assets. I assume that's exactly what you're doing within BOLD.
Absolutely. Every month we rebalance, and if Bitcoin does very well, then we take some out and put it back to gold. If it does badly, we take some out of gold and put it back to Bitcoin. That alone captures 5 to 7% excess return per year over buy and hold. So if you go back to 3.5 years when BOLD was launched, and if you took the original weights, which are about 22 and 78 from memory, something like that, and did nothing, versus where you are today, there's basically about 20 to 30% upside from owning BOLD as opposed to owning the two assets. And that's after fees. So,
wow,
it's a natural win, this pairing. There aren't many things like it, frankly.
What has the performance been since you mentioned you launched it 3.5 years ago? What has have you got there off the top of your head, or you can look them up, the annualized performance?
I have it right in front of me. So we launched in April 2022, and in US dollar terms, BOLD is up 119%, and gold's up 82%, and Bitcoin is up 166%. So basically, BOLD is in the middle of Bitcoin and gold, but it only had an average weight of about 28%. Does that make sense?
Wow.
So it's behaved.
So the Bitcoin had the average weight of 28%.
Yeah. And and right now on the numbers from the end of August, the excess return, I can tell you exactly, has been 20.7%. It's a bit lower than it was last month because we've had a very bad Bitcoin month and a very strong gold month.
Yeah, but as we record, gold is breaking out. Do you notice any kind of seasonality between them? So within my Bitcoin echo chamber on Twitter, I tend to see that people expect gold to break out and then Bitcoin tends to follow. So almost as if Bitcoin has a lag of X days or weeks on gold. So whatever we would tend to see in gold, we expect to see in Bitcoin sometime afterwards. Are you guys observing that?
Well, I know Raoul Pal goes on about that sort of thing. He thinks Bitcoin has a 6-month lag. I'm not convinced. I think they like different regimes. I think Bitcoin likes it when the stock market is roofing it. So Bitcoin likes it when the tech stocks, and it's got a very strong correlation with the Nasdaq. It's a high-performing Nasdaq, but the correlation is very, very high with the Nasdaq. And gold, the correlation has always been, even though people say the last 2 years it's reduced, it's been two tips. To real interest rates or inverse of real interest rates and tips, inflation-linked bonds. And, one's a risk-off asset, the other's a risk-on asset. So that's why the pairing's so good. And, if you said to me, right, you're not allowed to own BOLD, you've got to decide, Charlie, what, when you're going to trade Bitcoin and gold, and, you've got to swing the lever between Bitcoin and gold and outperform and show us how clever you are. I think I'd balls it up. I really do, because I think it's a very hard thing to do. Sounds easy, but it's actually quite hard. And having a systematic, simple mechanism of rebalancing and risk-averse asset allocation seems to work.
It's it certainly seems to, and I can see that being the dream sell to advisors, right? So you're minimizing the volatility, maximizing the returns. Right now, I believe that BOLD is only open to professional / sophisticated investors. Is that correct?
Yeah,
And then
nearly correct.
what?
It's listed in Germany and Switzerland originally, and France, the Netherlands, and Sweden. And in those countries have different rules. And I think in Switzerland and Germany, it's pretty much a free for all. So retail investors can buy it. In the UK, there's no UK listing currently, but hopefully there will be. But only elected professionals could buy it. So basically, the Bitcoin ban from 5 years ago on ETFs put them into the same category as hedge funds. And so you had to be sophisticated and high net worth and all that sort of thing. And then they might let you do an order. But actually, most brokers wouldn't even take an order, even if you're sophisticated, including the private banks. So they've made it very difficult for the Bitcoin ETFs in the UK to thrive.
What do you think's causing them to say no, even though it is open to professional, sophisticated investors?
Hey team, a very quick pause. If you're a financial advisor, wealth manager, or accountant, chances are your clients have already asked you about Bitcoin. And if they haven't, they soon will. Which is why I've created the Bitcoin IFA webinars. The webinars are designed to give you all of the information you need to confidently talk about Bitcoin with your clients. They're on demand, so you can watch them at a time that's suitable for you. They count as 90-minute structured CPD, and you'll get priority access to the Bitcoin IFA community. Head over to the bitcoinifa.com to book your webinar today. It takes less than 60 seconds. Again, that's the bitcoinifa.com to book. Now, back to the episode.
Well, I think I can only assume that in 2020, someone up top, and probably wasn't Labour because the Tories were in power, but someone said, this is a Ponzi scheme, we're going to be heroes, we're going to ban it, and therefore, when it goes to zero, we're all going to look really clever. But it was 10k then, and now it's 115k or something, or 110k, and 11x offside. That's a big short squeeze. But I think they just understand it, and as the years go by and Bitcoin keeps going up and it gets bigger and bigger, and now the US government loves it and all the rest of it. I mean, it just gets harder and harder to be a rational bet. And so the regulator, I don't think they're bullish or anything. They're just sort of, or the government and regulator and other actors who are behind this, the Treasury and so forth. I think they've just gone neutral, going hands up. Okay, well, there's a limit to how far we can have a view here. And really, capital markets, I don't really think that people in power should be making bets on capital markets. I think they should be respecting them and listening to what they're telling them.
Well, I suppose that's why people employ professional financial advice, right? So it should really be up to the advisor where they're able to allocate their clients' assets, provided there's a good reason to. So yeah, you're absolutely correct that it should be in the eye of the buyer beware. Was it caveat emptor?
Yeah.
So yeah, I completely agree. The FCA have protected us from 11x returns in 4 years. I don't know how many other assets have done those kind of returns in that kind of time, but the FCA are lifting the ban on retail ETNs, and we do expect there to be some kind of end report on their consultation at some point in 2026. So what are you guys doing for that? Is it, are you guys planning if the ban on ETNs, ETPs are going to be lifted? I'd imagine you guys are doing something about that.
Yes. So on the 8th of October, the ban is lifted, and no doubt the issuers, not just the one I work with, 21 shares, but others too, will have products from Bitcoin and Ethereum on the 8th of October. I'll be very, very surprised. I think the market will be disappointed if that hasn't happened, but I don't think anyone's been approved yet, so we're waiting for something to happen there. Boulder's going in the best possible speed. We're only a small firm. We can't, we don't have the top lawyers and that sort of thing, but we are coming, hopefully, this side of Christmas, and it's very exciting, and I can't wait to be finally be able to tell UK asset allocators about BOLD, because it solves a problem for them. Not only is it the natural non-correlation and the excess return, which is the sort of the good bit, if you like, but let's think about the bad bit. You've still got a system that's terrified of Bitcoin. I'm talking about the internal risk department, the compliance department. And so, BOLD solves a problem. If Bitcoin went to zero, which it's not going to do, but if it did in their eyes, well, at least there's 2/3 gold. So your product doesn't go to zero. It only goes down by a third. So I think that alone is a good reason to consider it. And the other one is the client meeting. If you're talking to do we still call her Mrs. Miggins, the sort of the fictional forever client?
I think they call them Mr. and Mrs. Client.
Oh yeah, Mr. and Mrs. Client. Okay, it was Mrs. Miggins, and when you're having that conversation with her, knowing that Bitcoin does work badly and well at times, and same with gold. If you own both, then you've got a lot to talk about. But if you own BOLD, there's just nothing to talk about because you've smoothed it all, and you've had a better outcome. So I think it's a very efficient way for a financial advisor, wealth manager, to start their journey in crypto. And no doubt in 5 years' time they'll be owning a bit of Ethereum and a bit of Solana and this, that, and the other. But what a great way on day one to go in very calmly and responsibly and keeping everyone happy at quite a difficult time because the industry is coming to this very, very late. Yeah, I'm not suggesting Bitcoin's over, not at all. But they could have made this decision back in 2020. I think they were about to. It was, the price was going up and it was all getting very exciting. And then the ban came. And so they've been saved by the ban. But actually, you know what I mean? In 2021, just as they were thinking how we're going to incorporate this stuff in our process, they then didn't have to because it was taken away from them. But now it's here. So they're going to have to make a decision on what they're going to do. And that decision could be, we don't own Bitcoin. Fine. Maybe tell your clients that's what you're doing. Vanguard's done it. If that's your case, then say it. But I think a lot of firms will say we are doing something, and they'll be looking for, the starter thing to do. Yeah, and still, I think it's only Bitcoin and Ethereum that's going to come in round one. No doubt, other projects will come along later. But there's not a lot you can do with Bitcoin and Ethereum in terms of making a sophisticated crypto portfolio or anything like that. So the starter point is, okay, what do we do about Bitcoin, where Bitcoin and Ethereum have the same returns for 8 years, and Ethereum's twice as volatile. I mean, what are you going to do? It's just had a huge rally. So it brings you back to, but if I'm starting from here, I'd focus on Bitcoin. And I think many advisors have a little bit of gold, and so a switch from gold to BOLD is a very, very easy first step for a wealth manager.
I think you're right. Although, I know, coming back to what you touched on earlier, which is that advisors like their products to be financial instruments. I think you call them, paying dividend. And so something like gold isn't what they would class as an asset because it doesn't pay an income. Bitcoin falls into the same category. But I mean, I think you're absolutely correct with BOLD. As soon as I heard about it, invited you on, I'm very excited about this and to tell financial advisors about it because I think it is a very easy stepping stone in, not necessarily for the advisors, but for the clients. If you say, look, we're buying you some Bitcoin, but we're buying you it with gold. So you're buying the newest asset, other than, unicorn fart dust, but you've got this brand new asset, 16 years old. It's the best performing asset of the last 16 years. And by the way, a 0% allocation to Bitcoin and saying we are never going to touch Bitcoin like Vanguard is essentially saying we believe the trend of the last 16 years is going to reverse. Suddenly equities and bonds are going to outperform Bitcoin. That's a strong bet to make. You may be correct. I personally don't believe you will be, but if that's your conviction, stand by it. But for advisors to go and speak to clients and say, look, we're going to put a portion of your portfolio into BOLD, which contains the newest digital money, 16 years old, really well performing, and gold, which is 10,000 years old, has always maintained its value, gone up in value. So we're going to combine these two things, the old world and the new world, and that's how we're going to portion off a slice of your portfolio over the next decade. I think it's a no-brainer. I think I'm very, very excited for you post 8th of October in this new world. So on that theme, where do you think BOLD would fit within a client's portfolio? So I like to talk about things. The way I speak about this is your vault and your engine. So your vault is your global equities, right, returning 10, 11% a year, all that's really doing is protecting your purchasing power. When you factor in debasement and inflation, that comes out at about 12%. So that's your real hurdle rate. Global equities, the NASDAQ, returns 12%. So that's your vault. Your engine is where you need to try and beat that 12% hurdle rate, right? So that's where you're actually creating wealth, not just protecting your purchasing power. Now, if you're in your 20s or 30s, your engine is going to be a much larger portion of your portfolio. If you're 70 and you're in decumulation, you've got enough money to last until you die, then your engine is probably a smaller portion. Where would you see BOLD fitting within that allocation? Is it going to vary by client age? Is it going to vary by not necessarily demographic, but where they are in their lifestyle stage? Do you see it in the vault, in the engine? How would you describe that?
Well, I think Dan, your way of describing that is spot on. I mean, the engine, we call that sort of risk on, don't we? We assume stocks are going to go up when things are going well, and we assume bonds are the vault, which are going to hold up when things are going badly. Not so true at the moment because of various issues to do with government overspending and so forth. But let's not go there. I'm sure you can find that in the papers. But the concept of risk on, risk off makes a lot of sense. And obviously, as you're aging closer to the taking your pension, drawing down, and so forth, you'd want to have more in the vault and less in the engine, wouldn't you? And so let's think about that in BOLD. I would very much put Bitcoin in the engine and gold in the vault. And let's call it a third, 2/3 of 1/3 Bitcoin and 2/3 gold. You just need to allocate away from bonds and equities, but maintain that advisor asset allocation. So I don't think it's a particularly difficult thing to do. You've just got to just so you can understand how much risk on and risk off you've got, and that's already done in the BOLD mix. But really, you've just got to understand whether you are a fan of alternative assets, which historically in an inflationary environment do better than financial assets. Look, pre-1999, alternative assets were dirt. Yeah, no one cared for them. Gold was $255. Bank of England was dumping it. All the rest of it. Bitcoin didn't exist. But quietly in the background, price of stamps, of rare stamps, and fine wines was really starting to bite. As the Chinese became rich, they were buying all the chateaus they could, and this sort of thing. And the art market went wild. And I come back to this idea of liquid alternative assets. And in the 2000 to 2008 period, when the dollar was falling, when the S&P was underperforming the rest of the world, everyone went nuts for alternative assets. Whether it was mining or commodities, agriculture, anything like that. There was even a diamond investment trust listed on the stock market. They just owned some nice stones called Diamond Circle. And there were just so many of these things, and there's lots of fashion to this. And then that all went out of fashion after 2008, where people respected cash flow again, just wanted strong balance sheets and cash flow. And that really just continued till the present day. And obviously the companies with good balance sheets and lots of cash flow are the big tech stocks, which have just become the ultimate fashion icon. But if you think that, in terms of investment, if you think that cash flow is a wonderful thing to have until that cash is trash. So if you have inflation, so if you say you've got $100 now and they give you $200 in 10 years' time with a growing coupon, you think, well, that's very nice. I'd love to have that. But the value of that collapses if the money at the end of the game is going to be worth, 50% less than it is today. And the entire benefit of that growth in the cash flow and growth in the terminal value becomes irrelevant. So that is why alternative assets, limited supply, hard, can't be inflated, this sort of thing, become increasingly popular in an inflationary environment. It happened in the 70s. It's happened through all meltdowns for any country. If you're living in a country and the system collapses, the guy who's got anything physical, whether it's a second-hand car, a grand piano, or gold coins, that is real lasting value. Who cares about the currency collapsing? And so that's when the mindset, the inflationary mindset, changes the assets we like in markets. And I just like to think that BOLD is the sort of one-stop perfect liquid shop. I think that BOLD is a sort of simple portfolio manager's solution to have a liquid alternative asset. That's really all it is. And if you want to get clever, go and buy Ethereum and go and buy silver and go and buy oil and all the rest of it. But this is a very simple step one in portfolio construction. You know, if we go into an inflationary environment, I would expect BOLD to outperform a 60-40 portfolio, 60-40 portfolio. And I think if we went to a hard money environment, i.e., interest rates went to 10% and they balanced all the budgets, and I think the BOLD would probably underperform a 60-40 portfolio.
I see.
The risk, Dan, owning BOLD is good government.
So the risk of owning BOLD is good government.
Yes.
I think you'll be fine. I mean, I think we are heading for an inflationary environment. As Lynn Alden says, there's nothing stops this train, right? There isn't a government on the planet with the way that our governmental cycles or democratic cycles play out, right? So every 4 years, you've got to get re-elected. Well, then why on earth are you going to implement a policy of balancing the budget for these 4 years? You're going to talk yourself out of a job. So nothing stops this train. They are going to print money. We are going to have an inflationary environment. And you're absolutely correct about assets within those environments suddenly becoming incredibly important. I can give you a real world example of this. I spent a few years in Lebanon, which is how I found Bitcoin. And I mean, I lived through their currency collapsing 99.9% in 3 years, right? So it went from 1,500 lira to the dollar to 120,000. So literally more than 100x in 3 years. And in that time, anyone who had cars, houses, so the price of houses, even in dollar terms, not even in lira terms, went through the roof. And cars, I mean, I at one point I was going to borrow a friend's car, right? This is quite naughty. I was just going to drive around for a week in a friend's car. Luckily, we didn't do it, but it was this 15-year-old beaten up Beetle, right? So like the new model Beetle, but it was at least 15 years old. And it was, it was crap. It was a pile of crap, right? And then I remember her a couple of weeks later saying, "Oh, I'm going to sell the car. I need money." And I was like, okay, how is that going to move the needle, right? In the UK, this car was worth 300 quid, maybe, right? And I was like, well, why? Like, how much is that going to get you? And she was like, oh, like $5,000. I was like, I'm sorry, what? This car is nonsense. And you're going to get $5,000 for this thing? And basically secondhand car prices, I mean, as you say, as soon as it went into that inflationary environment where the lira was melting, dollars were super important to have. The price of assets just went, astronomical, like, parabolic. So, if that is the environment that we are potentially facing, then having something like gold and Bitcoin, and I'm incredibly bullish on both. I think hard assets over the next few decades are going to be super important.
Yeah, I agree. And Lebanon's a fascinating but sad story at the same time. I think I went there in about 2009 or 10 for a wedding. It was a wonderful place at the time. It was between the wars, and they'd been doing all this development. And so I think I probably went at a very, very good time. Went to a nightclub at the top of some skyscraper. It was, and the people were welcoming and warm, and food was amazing. You could see it's had some good times, some bad. But it's been an unstable place in recent years.
It has, and kind of always has been, actually. So a bit of a brief history of Lebanon. It doesn't really grow much, right? So it's essentially two mountain ranges, right? So it's like the sea, bit of beach and a bit of land, mountain range. The Bekaa Valley, which is incredibly fertile, grows, but it pretty much just grows olives. Then another mountain range, then Syria, right? Olives and grapes. They have a lot of wine that comes out of the Bekaa. And so it doesn't really do much, right? So it doesn't really grow much. It doesn't produce anything. It's got no very, very limited natural reserves, although there is some oil off the coast that they found. And there is the potential that actually Lebanon and Israel may work together to get that oil out of the ground, which might, touch wood, lead to more stability in the region. But it's been fought over for 2,000 years, 3,000 years. It has continually been fought over, despite producing nothing, having no natural commodities. Just because of geographically where it was. It was the end of the Silk Road and then the access to the Med, right? And what you want to do when you're bringing a lot of large produce from China to Europe is you want to get it onto a buoyant, naturally, fighting gravity with, as Michael Saylor would call it, you want to use the buoyancy of the water to fight gravity to travel faster. So Lebanon is literally the entry point to the Med for the Silk Roads. So it's been fought over for years just for geographical importance, despite doing nothing. But it did have that period. I mean, I remember when I went out in 2020 and people were like, is it safe? And you're like, isn't it at war? And you're like, the Civil War ended in 1990. So literally 30 years later is when I was heading out there. But you're absolutely correct that it had its heyday. It was probably between sort of when you were there, because they had a war in 06. So between sort of 2007 and 2019 was this beautiful period for it. It was the Paris of the Middle East. The good times were roaring, but the good times were roaring because surreptitiously the Lebanese government were printing more lira than they had dollars to back the peg, because the currency had been pegged for 30 years, 1500 to the dollar. And so classic, if Bold's biggest risk is good government, well, if Lebanon's government is anything to go by, and most of the other governments, they're all surreptitiously printing in the background. So I'm not sure that's going to happen, Charlie. And there was something else you touched on as well, which is the potential for index funds. So I think you're right in that. So we're obviously getting the Bitcoin ban is lifted 8th of October. We're expecting the end of the consultation and a report from the FCA in 2026 at some point. And I think you're right in that we may end up at that point with some kind of Bitcoin ETH, fund, something like that. Those might be the two that end up being regulated initially. But there are a lot of crypto people out there, and some. I'm a Bitcoin maxi right now, but I'm aware that some cryptos, especially some of the layer ones, may end up offering, something in the same way that the Mag 7 does, right? But the way I like to talk about this is, if you go back 20 years, no one could have predicted Microsoft and Apple 20 years ago. You may have said, okay, they've probably got some future, but until the iPhone in 07, Apple wasn't that important. But no one could have predicted Amazon, Nvidia, Meta, Tesla, right? And I think it's the same today with crypto, which is, yes, there's layer ones, but I can't tell you 20 years from now which of those are going to work. Some of them will, some of them won't. So I think you're right in that there will be passive index fund of crypto passive index fund. And how do you see BOLD working with those in that kind of environment? Do you see it as competitive, complementary?
Hey team, just a quick pause to say a huge thank you. You've given us your most precious assets, your time and your attention. And honestly, it means the world to us. If you've enjoyed this episode, or you take value from these conversations, it would really mean a lot if you could like, comment, or subscribe. Those things really help the algorithm, and they help the channel to grow. And if there's someone in your life who would take value from this, maybe a fellow advisor or someone just curious about Bitcoin, please send it their way. You never know what it might spark. Okay, back to the studio.
I think it's the next step. So if you think about it, you're 2 steps up from where we've been talking. So your first step is BOLD. Your second step is Bitcoin, pure Bitcoin. And your third step is crypto. Is that the sort of simple answer? And you obviously can get really clever about it and that sort of thing. But the reason I wouldn't write off most of crypto, or much of it is rubbish, of course, but things like Ethereum. Ethereum powers a stable coin. Without the stable coin, the Bitcoin ecosystem wouldn't be nearly as strong and valuable as it is today. It's instrumental partnership. And I think Ethereum really delivers this dream of, and Solana and Near and others, this dream of, digital title, digital ownership, and to be able to. I believe that all the shares and bonds will end up on the blockchain in the next 10, 20 years, whatever. And we won't really notice. Someone's described it as you won't really notice the fact that they just sort of naturally merge together. So one of the things when I started, I think share trading was sort of T+5, which meant you traded and then you paid 5 days, you settled 5 days later with cash, or in reverse, and then it went down to T+4, then 3, then 2, and basically people want to be able to trade and get their money faster as technology progresses, and the stable coin enables you to do T+ now. So if you're buying and selling Apple shares or Bitcoin, doesn't matter which, and you want to have instant payment, well, a stable coin enables that in a way that the current banking system doesn't. So there is a natural progress with this technology, and I just think financial markets will work this way in the future. So Bitcoin's not just a store of value on its own; it's created an entire financial system or asset base on the internet, and I think it's early days. There's a lot of good ideas out there, and which ones catch on, as you say, who knows? There's more to come.
Yes, absolutely. It's good. Yeah, it's going to be a wild decade or two. But the ones that I do feel very confident about, right, 20 years from now, are Bitcoin and gold, right? The hard assets. If we go into an inflationary environment, as you suggest, or as you mentioned, you didn't suggest it, I'm suggesting it, so that's why I like to, when people do come to me and ask, in fact, I had just the other day, my dentist from Lebanon text me, and we were talking about this 2 or 3 years ago. I was having some dental work, and he was like, I'm going to invest. Should I go into gold or Bitcoin? And I said, look, personal preference, I would go into Bitcoin. I saw him again a month later, and he said, I've bought gold. I was like, no problem. Like, I still think that's going to be fine. It's not going to return as much as Bitcoin over the next 3 years, but it will do okay. He texted me 2 days later and was like, I'm finally into crypto. I'm 3 years late. What should I do? And I just said, look, buy a small amount of Bitcoin every day for the next 10 years. That's it. Because 10 years from now, 20 years from now, I think Bitcoin and gold will still be incredible stores of value. Other cryptos, no idea. Some of them are going to work, some of them won't. The technology, you're absolutely correct. The underlying technology is going to be fantastic. And you're absolutely right in that stocks and shares trading will move to the blockchain. Like, I can't send, why I would, I don't know, but I can send someone in Hong Kong £1,000 worth of Bitcoin on a Sunday night. I can't do that with my Apple stock or my Nvidia shares, for example. I don't know why I would want to, but they are going to move that way. Everything will move onto the blockchain eventually. It's a really good point. Charlie, what have I not asked you about BOLD that you would like to mention?
Oh, what's our website? BoldETF.com. There you go. On that website, which we spent a lot of time and effort on, it just gives full transparency of what it is, how much Bitcoin and gold there is, how the algorithm, the very, very simple algorithm sounds fancy, which is the simple monthly rebalancing equation works, and the all the performance and the daily weights and the target weights, and then some interesting stats around Bitcoin and gold flows from the ETF industry. All the Bitcoin and gold ETFs in the world are $500 billion combined, which is about 2/3, 1/3 in favor of gold at the moment. Bitcoin obviously catching up. So we do quite a lot of fun stuff on boldetf.com to really get a better understanding of how these two assets coexist. So we've got lots of charts to support that, all daily updated charts. So please go and have a look and tell what you think.
Great. We'll include that in the show notes as well. Charlie, we always ask the same question to close out. What's one positive thing that Bitcoin has brought to your life outside of number go up?
Yeah, well, I think the easy answer to that question is the belief that there are internet assets. I think we've touched on that. And it's also been a survival of the fittest. To be able to watch it in action so much faster than ever happens in the real world. just to be able to see, with this idea put onto the internet in 2009, and off it goes. No one even knows who did it, and it's happened. And there's just been this Wild West journey, just like the takeover of California, in the 19th century, the gold rush and all that, very, very similar. And it's just been crazy. It's run circles around regulators. It's been fun to watch. I think that, one of my snippets is that Bitcoin is the only asset class, crypto is the only asset class ever to have a sense of humor. And if you follow it, there's also been the gains and there's been the pains, but it's always been funny. And it really is alive. The community is really alive in that sense, keeping everyone's humours up through this this period of extraordinary creative destruction. It's been a lot of fun to watch it, and I enjoy it. And I also think it's fascinating how Bitcoin's some kind of risk indicator. When it's doing well, you just generally know the world's doing well, and when it's doing badly, there are other problems elsewhere that which haven't been highlighted. Yeah, and the whole sort of innovation has been fascinating too. So yeah, it's brought so much to the world, and it sort of forced people to wake up and say, well, if you don't really understand what's happening in computing, the innovation keeps on going generally, and here, assets on the internet, get over it, it's happening.
I love that. That's a great place to end. Charlie, thank you.
Thank you, Dan.